So the US government just passed Trump's controversial One Big Beautiful Bill. And so what's the impact on the stock market and on specific stocks and sectors? Well, let's break it down in this video. Now first, remember to grab your free ticket to Retail Rebellion, which is my upcoming live online event. Registration starts right now. Details in the description box below. So yesterday, Trump finally signed the Big Beautiful Bill, which is a major piece of legislation on his tax cuts as well as his spending and funding bill. Now, of course, America is deeply divided, and Democrats all hate the bill. Well, not all, but most of them hate the bill. They're saying that it robs the poor, gives to the rich, makes the rich richer, the poor poorer. And of course, most Republicans back the bill. Now, I'm not going to judge on the politics of it because I'm not American. So I'm purely going to look at it objectively from a stock market perspective. And what does it mean for stocks, and which stocks will benefit and which stocks may not benefit as much. So first and foremost, what are the highlights of this huge legislative bill? Well, number one, massive tax cuts, about 4.5 trillion in tax cuts over the next 10 years. First, corporate tax cuts. Now, Trump in 2017, he had corporate tax cuts. He cut corporate tax from 35% to 21%, and they were actually due to revert back to 35%. But this new bill makes those cuts permanent. And in addition, allows businesses in the US to immediately write off 100% of the cost of equipment and research. So is this good for stocks? You bet. So this is significantly positive for corporate earnings because lower tax, more profits, more earnings per share, and this will also boost corporate investments. And I'll talk more about it in detail in a while, which companies will benefit, which stocks will benefit. And of course, number two, individual tax cuts. So what he did was he extended and added new tax breaks, including deductions for tips, for overtime pay, and the child tax credit is also boosted. The bill also quadruples the state and local tax deduction cap to $40,000 for 5 years, which is very beneficial for high income tax states and very beneficial for people who earn a high income. So what does all this do? What does individual tax cuts do? And you can write off more stuff on your taxes. Of course, this will increase disposable income. Americans who have more disposable income, they can spend more. So this would increase consumer spending and hence GDP. Again, great for the stock market. So those are the tax cuts. The second main highlight would be, of course, fiscal stimulus, which is the government spending more money, which can be good, can be bad. Good in the short term, long term, maybe not so good, right? So increased spending of $350 billion specifically on number one, border and national security, significant funding for the border wall, for migrant detention facilities, and hiring of new ICE and border patrol officers. In fact, I read somewhere that the budget for new ICE officers is bigger than the entire military budget for Russia. That's a big thing, right? Defense. So defense contractors will, of course, make billions of dollars for shipbuilding, munitions systems, and Trump's Golden Dome missile defense system. So what does all this do? This will increase government spending, which is fiscal stimulus that will boost GDP, at least in the short term, and boost selected sectors like defense contractors, infrastructure, and construction stocks. So again, another plus for the stock market, at least in the short term. Now, the other thing which I actually love if I was an American, and by the way, great if Singapore government can do this as well, is Trump's accounts for child savings, which is going to probably be about 14.4 billion over the years. So in the bill, basically, if you have a child that's born from 2025 to 2028, which means 4 years old or younger from now, you get a new savings account for your children. And the government gives a one-time deposit of $1,000. So every child gets $1,000, and then parents are able to contribute $5,000 a year, and the balance will be invested in a fund that tracks the US stock index, like the S&P 500, and be able to compound their earnings tax deferred. So I think this is a fantastic idea to, number one, you get a direct inflow of new capital into the stock market over a multi-year period. and it will introduce a whole new generation of young people to investing and encourage broader participation in the stock market. China should do this actually, right? Now, so it's going to cost the government a lot of money. So where's the money going to come from? Okay, so they're going to cut from somewhere to pay for something else. So spending cuts. So this is where, of course, the Democrats are not very happy because they're going to cut a lot of Medicaid. So Medicaid is basically, in America, it's a health insurance coverage for the poor and low income people. Yeah. So they plan to cut about $1 trillion from Medicaid over several years and cut $300 billion from food assistance programs, which are food stamps. And so major reductions to these programs would require people to make sure that they work and before they can get these so-called food stamps and Medicaid, right? You can't just leech off the government. And that's the Republican point of view. And of course, there are much stricter sign-up rules that only citizens and not undocumented immigrants get access to this, which I think makes sense, right? But again, I'm not gonna judge politically. I'm not American, right? You guys figure it out. I'm just gonna tell you, how it affects the stock market. And of course, finally, will be regulatory rollbacks. This bill will cut environmental and labor regulations, less red tape, less bureaucracy, and you'll fast track fossil fuel projects. So all this will cut operational costs for companies in these industries, especially oil and gas companies, and increase their profitability, specifically for oil and gas stocks. So this is all the good stuff, but as you know, there's no free lunch in this world. There's always some potential negatives. So what's the negative impact of this bill? Now, there are two schools of thought. So of course, the major concern people have would be this bill is going to increase the US government debt significantly and widen the deficit. So the Congressional Budget Office estimates that this bill will increase the federal deficit by 3.4 to 4.1 trillion over the next 10 years. And this could raise the debt to GDP ratio of the US government to 120 to 124% by 2034. Now, Elon Musk, as you know, right now is very vocal about it. In fact, he said that this bill is terrible, is going to enslave Americans to debt for the rest of their life, and it's now come out to form its own American party to kind of like give voters another choice. So good luck to Tesla shareholders. I'm just kidding. Actually, I like Elon a lot. I have tremendous respect for him, right? And what he's actually doing. Now, so is he right? All these economists right that the bill will increase the deficit? Honestly, I don't know, right? And do I 100% trust these economists? Not really, right? Because they said 2023 recession. Didn't happen. They said this year recession, we're gonna die. Didn't happen, right? So you've got to keep an open mind. But if this is true, if it does increase the US debt and people say it's unsustainable, is it going to collapse eventually? Maybe, right? But you know something? I started investing in the US stock market in 1996, and that's what they said at that time, that the US debt was unsustainable. This was 30 years ago. And I still remember that in 2008, 2009, after the great financial crisis, they say America will never recover, the financial system is destroyed, we're gonna die. And that was, 20 years ago? And since then, the market has done so well, and America's innovation and businesses have gotten even stronger. So, I don't know, for me, I'll never bet against America. I'm not American, I'm looking at it very, very objectively. But let's say the worst happens. Let's be very pessimistic and say that, okay, the debt goes up like crazy. What's going to happen then? Well, the effect is that it could drive up long-term interest rates, right? So less people may want to buy US government debt, or people may sell US government debt. That could increase the 10-year Treasury yield up to 1.2 points extra. This is based on what economists say. So that means the 10-year yield could go up to more than 5.5% by 2054 and drive up inflation. So is this bad does it mean that the stock market will collapse? I don't think so. Is it bad for stocks? Certain stocks, yes, very, very bad, but certain stocks will not be that affected. Okay, why? Think about it. If long-term interest rates go up, okay, it will be very bad for speculative growth stocks. These are stocks that have high price to sales multiples, that don't make much profits, but they are very much driven by, again, a lot of liquidity in the markets. But with high interest rates, these stocks will have much lower valuations. So again, these are stocks with very low profits or not making money, but again, speculative stocks. So these will do very badly. And the good thing is that I don't really buy these kind of stocks at all, okay? Number two, small to mid-cap stocks may also suffer, because small to mid-cap businesses, they tend to rely a lot more on funding, okay, on borrowing. So if high interest rates increases their cost of business, they'll do very, very badly. And again, for me, I also don't really touch these small to medium-sized companies, so I don't really care. Next, highly leveraged stocks. So again, certain companies that take on a lot of debt and leverage, they'll also suffer in that kind of high interest rate scenario, which I don't touch as well. REITs will get whacked with high long-term rates. But again, this pertains to the US, and I don't own US listed REITs, so I don't really bother. But it may affect certain Singapore listed REITs with a lot of US exposure, may affect. So I keep that exposure to a minimum, right? And it's also negative for companies that lack pricing power. If inflation flares up again and inflation continues to go up a lot, then of course the low income will suffer the most as their purchasing power erodes, right? And companies that are not able to pass on the higher cost to their consumers will also see a squeeze in their profit margins, and their stocks will do very, very badly. But companies that have got what we call pricing power, that means the companies can raise prices every year to pass on the extra cost to consumers, they will continue to do well. All right. So in a nutshell, if the worst happens and debt to GDP keeps going up like crazy, the debt becomes very, very high, higher interest rates, higher inflation, great companies that have low debt, strong earnings, free cash flow will still do well. It's all the other companies that are weaker that will get crushed. But you know something? A lot of people think that, the US debt is so bad, and that's the narrative the mainstream media likes to tell you. But I can tell you that many countries are in worse shape. People think that China's debt is lower than the US. Not really, right? Their actual debt to GDP is something like 160% if you include their shadow banking system. And if you're interested, leave me a comment below. If I get enough interest, I'll do another video just talking about that, on China's actual debt situation and why it's actually much worse than the US situation. But the media doesn't like you to think that way, right? They like to spin a different narrative. Okay, so anyway, so that's one point of view. Now, on the other hand, Scott Bessent, who is the Treasury Secretary, he is saying that no, these economists are wrong. Elon is wrong. He's good at rockets, but he's not good at finance, right? And he says that, in fact, the tax bill will not add to the debt, right? The bill pays for itself. And his argument is that the tax cuts and the regulatory rollbacks will stimulate so much more economic growth that will lead to much higher GDP and increase investment and job creation, that the expanded economic activity will generate enough new tax together with the tariffs that will offset the cost of the tax cuts and the increased government spending on ICE and on defense, right? And in fact, the One Beautiful Bill includes 1.7 trillion in mandatory savings from Medicaid and the food stamp cuts. So who's right and who's wrong? Is Elon right in suggesting that it will lead to massive debt slavery, or is he just pissed off that he didn't get the NASA pick that he wanted to get and he's just taking revenge? Is Scott Bessent right or is he wrong? Honestly, I don't know. I'm not that smart. But you don't have to be very smart to make a lot of money from the stock market. You don't, right? So for me, my philosophy is to just hold a portfolio of great companies that we have to use all the time, right? Or, whether you like it or not, you got to use Microsoft, Nvidia chips, Google Search, or Gemini, or Visa, or MasterCard, or go to McDonald's once in a while, or drink Coke and Pepsi. We got to use this stuff all the time. So when you got a portfolio of great companies that have strong free cash flow, strong moats, and little or no debt, then it doesn't really matter, does it? Whether is it high interest rates, low interest rates, economic growth, economic recession, whether you got high inflation, low inflation, it doesn't matter if you have companies that have got pricing power and don't require low interest rates to do very well. And that's my whole philosophy, is to have a portfolio that does well no matter what happens. Okay, so let's drill down to specific sectors. Which sectors will be positively impacted and which will be negatively impacted? So first, positively impacted sectors will be number one, manufacturing companies. Why? Because with this bill, companies are able to write off 100% of their equipment and research costs from their taxes. So this will encourage a lot of capital investment and will be highly beneficial for manufacturers. There's a lot of incentives also for domestic manufacturing, particularly semiconductors. So semiconductor companies with US operations should benefit a lot from this. Companies like your Taiwan semiconductor manufacturing company that is now building more and more plants in the US. You've got Micron, you've got Nvidia. And they will again benefit from these enhanced tax cuts for US-based manufacturing. Now, some of you would ask, how about Intel? Would Intel benefit? Yes, Intel would benefit, but I'm not putting Intel down because Intel is not as high quality of a business as it once was, and compared to these other companies that are a lot more higher quality. So for example, if you use Stock Oracle that's available to my students, you can see that Intel, it looks fairly priced, right? In fact, it's slightly undervalued, but it doesn't have a very strong economic moat. You can see that in this AI revolution, it's still losing money, right? It's losing its negative profits, negative free cash flow, so very low in profitability, not very predictable. Growth is medium, and it's got a very weak moat. And if you look at the charts, for example, you can see that in a medium term, short term is going sideways, but long term it's still very much on a downtrend. So even though it will benefit from this bill, but because it's not a high quality company, I'm not interested in it. But if you look at a company like TSM, for example, Taiwan Semiconductor Manufacturing Company, you can see it's very, very profitable, right? Very highly predictable, high profitability, high growth, strong moat, very wide moat, high financial strength. And you can see right here from the moat analysis, it's got a 9 to 10 moat score of TSMC. Now, I don't own TSMC because I prefer to own Nvidia, right? Because I don't like TSMC for the fact that it's very capital intensive. They've got all these fabrication facilities, although they are monopoly, but I prefer a company that is a bit more asset-light, if you will. So as you guys know, Nvidia is one of my biggest positions. And Nvidia currently is already overvalued, right? I bought a lot more when it was like $90, $100. And of course, I bought a lot at 15, all right? But right now it's overvalued. So one has to, again, wait for the price to drop below the intrinsic value to add more. So even though Nvidia will benefit, but right now, at this moment, will I add more? No, I'll just hold my position. So again, Nvidia, very predictable, high profitability, high growth, strong moat, financially very strong, but of course, valuation is not great, which means that it's currently overpriced. And you can see it's got a very strong moat score over here. If I click on the economic moat analysis, you can see it's got a 9 out of 10 moat. Very strong pricing power. It can raise prices and overcome inflation easily, passing on costs to consumers, high barriers to entry, high switching costs, high network effect. Well, this is medium, but okay, more than 5, and huge economies of scale. All right, so that's Nvidia for you. That's why I own Nvidia, one of the biggest positions in my portfolio. Now, of course, not just semiconductor companies, but other industrial companies involved in infrastructure and capital goods will be positively impacted by this bill. Companies like General Electric, which is a pretty good company, Honeywell, not bad as well, Union Pacific Corporation, railroads, also pretty strong company, American Tower, very good company, Vulcan Materials, not bad, Kinder Morgan, not as great, Caterpillar, pretty strong as well, and John Deere. So all these will have a tailwind from the bill. Next, fossil fuel companies, oil and gas companies. Trump loves oil and gas. Drill, baby, drill. So this bill delays methane pollution fees, rolls back vehicle emission rules, and includes tax workarounds to help all drillers avoid the corporate alternate minimum tax. So all this would increase profits for oil and gas companies. Companies like your ExxonMobil, Chevron, ConocoPhillips, and of course, Buffett's favorite, Occidental Petroleum, right? But for me personally, I don't touch oil and gas companies because Their earnings are very unpredictable. It depends on oil prices. And to me, oil prices are in a long-term secular downtrend because, again, the US is drilling, baby drilling. So gas supply, oil supply is very high. So I don't see oil prices going up very much in the long run. So although oil companies will benefit from lower taxes, but I won't touch oil companies because of those reasons. And okay, next, defense contractors, obviously, right? So this bill will increase the armed services spending by 150 billion, and the defense budget of the US will exceed 1 trillion annually. And funding for specific projects like the Golden Dome missile defense system, and in particularly defense contractors that have an AI and technology focus will benefit the most. And so my Palantir, which I'm still holding half of it, I already sold half, holding the other half, which I bought at $9, right? I continue to hold Palantir, although Palantir is very overpriced, very overvalued, but I'm still holding it, right? Because I think there's a huge runway, and eventually the earnings and cash flow may grow into the valuation, right? Of course, you've got other defense stocks that will benefit, like Lockheed Martin, which I don't own anymore, although it's still a good company, Raytheon Technologies. In fact, I invested in the Global X Funds X Defense ETF SHLD 1 year ago, which I notified to my subscribers, my students, and even shared in my live public webinars as well, and that has gone up 77% since the last 1 year. So I think this will continue to do well because it again contains many of the AI and technology focused defense contractors, not just in the US, but in Europe as well. Next, finance stocks should benefit as well. In fact, financial stocks have been one of the top performers this year because with tax reliefs, you will have a boost in corporate and consumer lending, and this will increase disposable income and corporate investments. And of course, banks will benefit very much from it. Your Bank of America, your Goldman Sachs, and your JP Morgan. But they're all pretty high right now. They're all overextended, so I won't jump in right now. Always wait for a pullback, a retracement back below intrinsic value, back below support. So you got to look at intrinsic value. You got to look at support levels. It is crucial. Next, retail and consumer discretionary. So with more tax cuts, individuals obviously will have, again, higher disposable income, and this should boost consumer spending for non-essential goods, for retail and consumer discretionary goods and services. So what are the top retail or discretionary companies? You got Amazon, you got Walmart, you got Lowe's, you've got Booking.com, you've got Nike that's beginning to rebound, and of course, many, many others. Next, small cap and regional stocks. So small cap stocks, those in the Russell 2000, and I've bought the small cap growth ETF about 2 years ago. It still is doing okay, but I think there's a lot of upside is going to come once rates come back lower this year. So these names will benefit the most from the change, allowing interest deductions of up to 30% of EBITDA. This will boost small cap net income by 12% as per Barclays research, equating to positively tens of billions in savings. Now, of course, if the worst were to happen in the long run, if the bill increases the US debt and long-term rates go up, then that would hit small caps negatively. So short-term would be good for small caps, but long-term, again, the jury's still out on that. Okay, finally, which sectors will not be that well impacted by the big beautiful bill? Number one, certain healthcare stocks. Those that are very much exposed to Medicaid, which is again the health coverage for low-income groups. So with the one big beautiful bill, we've got 1 trillion in cuts to Medicaid, which includes work requirements and stricter sign-up rules. So this is projected to result in millions of low-income people losing health insurance by 2034. Approximately 11 to 17 million people may lose their health insurance. Again, these are the low-income people. And which companies will be the most affected? It will be managed care companies that have the greatest exposure to Medicare. The biggest impact would be on Molina Healthcare, ticker symbol MOH, because Medicaid makes up 90% of their members. Second, or worst impacted will be Centene, ticker symbol CNE, where almost half their members are on Medicaid. All right. Now, I also own some healthcare managed care stocks, as you know, United Health and Elevance Health. And although they do have exposure to Medicaid, it's a lot less. So like Elevance Health is like about 19% exposure to Medicaid, and United Health about 15%. So they still have a lot more of a diversified portfolio to weather that impact. It will also affect hospitals and healthcare systems that rely heavily on Medicaid reimbursements, like CYH, Community Health Systems, and Tenet Healthcare, THC, which serves more of the rural or lower income populations that expose more to Medicaid. Now, I own HCA Healthcare, but that is doing pretty well, and it doesn't have much of an impact on that because they don't have that many low income Medicaid people, right? Next will be, of course, renewable energy and clean technology. For some reason, the Republicans and Trump, they want to move away from these alternative energies and go back to fossil fuel and nuclear energy, which I'm not saying is good or bad. Again, I'm not judging here. So this bill will repeal $500 billion in clean energy tax credits, including those for electric vehicles, solar, wind, home EV charging equipment, no more tax credits, and energy efficient home improvements, no more tax credits. So this will negatively impact solar panel manufacturers, battery plants, and EV makers. So obviously, Elon's not too happy about that, right? So negatively impacted would be, of course, Tesla, First Solar, Enphase Energy. Finally, low-income consumer goods and services companies. So with Medicaid and SNAP cuts, SNAP would be the food assistance program being cut like $1 trillion, requiring more work requirements for adults aged 18 to 64. This may reduce income for low-income households by $700 a year for the bottom 20%. This is based on Yale's Budget Lab research. So this could decrease demand for budget, retail, and food services, impacting companies serving low-income consumers. So companies like Dollar General and Dollar Tree may be negatively affected by this. So that's an overview of the Trump's One Big Beautiful Bill and how it impacts the stock market. So I would say overall, in the short term, it is a positive for the market. It should boost profits and valuations higher. Long term, like I said, the jury's still out whether it will bring the debt up much higher. And like I said, if it does, certain companies will be impacted. But companies with strong free cash flow, with low debt, with pricing power, they will continue to do well. So remember, before you go, register to get your free ticket for Retail Rebellion, my upcoming online webinar event that I'm going to be conducting with Bang Fan Van and Alson Chu. Registration starts right now. Details and the registration link in the description box below.